A seismic shift is hitting the global financial markets. On June 16, the Bank of Japan is widely expected to hike interest rates to 1%, the highest level seen since 1995. By watching this video to the end, you will understand why this isn't just a minor policy tweak, but a full regime change that could trigger a massive unwind of global carry trades. With the yen pinned near 160 against the dollar, the stakes for the BOJ have never been higher. For decades, Japan has served as the world's zero-rate anchor. This ultra-easy monetary environment fueled the carry trade, where investors borrowed cheap yen to invest in higher-yielding assets globally. However, persistent yen weakness has forced the BOJ's hand. As US dollar to Japanese yen stays stubbornly above 160, the market is signaling that the era of normalization is no longer an option, but a necessity to prevent a total currency collapse. This historical pivot marks the end of an era that defined global liquidity for a generation. The data is startling. Despite the Ministry of Finance spending a record $74 billion in FX intervention to support the yen, the currency remains under immense pressure. Market participants have fully priced in a 25 basis point hike, bringing the policy rate to 1%. Currently, US dollar to Japanese yen is pinned near 160.50, just below the pre-intervention highs of late April. Traders are watching closely as the BOJ prepares its move on June 16, knowing that previous attempts to support the currency through direct intervention have largely failed to produce a lasting trend reversal. On X, the sentiment is one of extreme caution. Traders are highlighting that the market has fully priced in the 25 BP hike, suggesting that anything less could lead to a violent move in US dollar to Japanese yen. Some market participants are noting that US dollar to Japanese yen is perched above critical intervention levels, with gains exceeding prior trigger points used by the authorities. There is a palpable sense that the BOJ is being forced into this hike to defend the currency, rather than purely based on domestic inflation dynamics. The consensus on social media is clear: the yen is at a breaking point. Institutional analysts are sounding the alarm. Strategists from Scotiabank flag that yen gains are already exceeding prior intervention trigger points. Meanwhile, experts at BBH observe that US dollar to Japanese yen is staying pinned near the 160.50 level as the market awaits the June 16 decision. The consensus among bank strategists is that a hike to 1% is no longer a mere policy adjustment, it is a regime change. They warn that this move signals the BOJ is prioritizing FX stability over its previous accommodative stance, marking a significant departure from decades of policy. For the Nikkei 225 and broader Japanese stocks, this rate hike represents a double-edged sword. While it signals economic normalization, the risk of a global carry trade unwind is hitting equities, commodities, and bonds. A stronger yen typically pressures Japanese exporters, but the more significant concern is the withdrawal of cheap liquidity that has supported asset prices worldwide. Investors are bracing for volatility as the regime shift begins to impact corporate earnings and valuation multiples across the Tokyo market. The impact of the BOJ's move extends far beyond Japan's borders. Analysts warn that a hike to 1% could trigger a spike in the US 10-year Treasury yield, potentially testing the 4.75% level. As the BOJ, the world's zero-rate anchor, removes its support, global bond markets must recalibrate. This could distract from other geopolitical headlines, as the bond market undergoes a fundamental regime change. The era of the carry trade, which funded global risk-taking, is unwinding, putting pressure on everything from US Treasuries to global commodities. For individual investors, risk management is now the top priority. With the June 16 meeting fully priced in, the danger lies in a hawkish surprise or, conversely, a move that the market deems insufficient. If the 25 BP hike fails to stabilize the yen, further intervention from the Ministry of Finance is likely, creating a sawtooth pattern in the charts. Investors should closely monitor the 160.50 level in US dollar to Japanese yen. Avoiding aggressive carry positions and focusing on high-quality assets that can withstand higher global yields is the key strategy as we enter this new regime. Looking ahead, our AI model identifies 3 scenarios for the June 16th meeting. In the base case, the BOJ hikes 25 BP to 1%. Markets remain steady as this is already priced in, with US dollar to Japanese yen hovering around 160. In the bull scenario for the yen, the BOJ delivers a hawkish surprise, perhaps a 50 BP hike or aggressive guidance on future moves. This would likely trigger a massive yen rally, potentially pushing US dollar to Japanese yen toward 155, but causing a sharp sell-off in the Nikkei. In the bear scenario, if the BOJ hikes only 25 BP but sounds hesitant, the market may perceive it as too little, too late, potentially driving US dollar to Japanese yen past 162 and forcing the MOF into immediate, massive intervention. To summarize, the BOJ is set for its highest rate since 1995, the $74 billion intervention has reached its limit, and global bond yields are on notice. This is more than a hike, it is a regime change. How are you positioning your portfolio for a 1% BOJ rate? Let us know in the comments below. Don't forget to like and subscribe to Tokyo Macro for deeper insights into the Japanese markets from the inside. Thank you for watching.